Hi, good afternoon, everyone. We're going to get started in just a minute. I'm going to let a few more folks arrive into the webinar here. All right, well, let's get started, and we will note right at the outset that this is going to be recorded and will be posted on YouTube. So those of us, those of you joining a little bit late will be able to catch it on YouTube. Thanks everyone for joining us today. I'm going to stop sharing my screen so you can see all of us. So good afternoon. I'm Ben Keys, a professor of real estate and finance at the Wharton School. And I'm really excited to be hosting today's webinar. I'm joined today by four fantastic experts to be talking about issues related to climate risk, insurance, the mortgage market, and the housing market writ large. So I'm going to do very brief introductions. The panelists are each going to take about 5 to 7 minutes to give a bit of an introductory spiel and overview of the things that they're thinking about and working on at the moment, and then we will open it up to questions, first from me and then from the audience. So I'm excited to get the audience's feedback. So please enter your questions in the chat box or in the Q&A, and we'll go from there. And we go until 4 o'clock. So we're joined today by Kristy Dahl, a senior climate scientist for the Climate and Energy Program at the Union of Concerned Scientists. Michael LaCour-Little, who's the Director of Economics and the Economic and Strategic Research Group at Fannie Mae. Matt Kahn, who is Provost Professor of Economics and Spatial Sciences at the University of Southern California. And Lynn Fisher, Deputy Director, Division of Research and Statistics at the Federal Housing Finance Agency, the FHFA. So we're going to be hearing from each of those four folks in turn today. So Kristy, let's start with you. Just looking at the front page of the newspapers, we have Hurricane Henry in the Northeast, we have floods in Tennessee, and just recently we had the new IPCC report, which is telling us about the state of climate science and our understanding of climate risks. So where are we right now in thinking about these risks, sort of both for today and into the future?
Yeah, thanks, Ben, and thank you all for listening in today. I'm looking forward to the conversation, the other panelists, and to learning from your questions. So just to kick us off and to respond to Ben's prompt there, where are we in terms of the climate science? I think a good place to start is with some of the top level findings from the IPCC report that was released earlier this month. So as many of you likely know, the IPCC is an organization made up of 195 nations. And every 6 or 7 years or so, they put out a major report that summarizes the state of climate science. They released the first section of that report a couple of weeks ago that looks at the physical science findings. And in the next year or so, we'll see reports on adapting to climate change and how to mitigate climate change as well. But what they found in this physical science report that they released was that it's now considered unequivocal that humans are influencing climate change. So using their strongest language yet, you've seen that language get stronger and stronger, with each of their assessments since the first one in 1990. In addition to that, they communicated an increased level of certainty about many of the trends that a lot of us are experiencing in our daily lives, and a lot of the science has been pointing to over the last few decades. So things like greater certainty that there has been an increase in precipitation or rainfall over land, greater certainty around the increasing frequency of heat waves, and a greater certainty around the proportion of tropical cyclones or hurricanes that are reaching the strongest categories, the strongest severity. They've also sent very clear messages about the attribution of those trends to human causes. So this is a field of science that has opened up dramatically over the last decade or so, where scientists are more able to attribute trends to human causes, or to say even for a specific event, such as Hurricane Harvey in Texas. How much more likely was that extreme rainfall made by climate change? There are a couple of big take-home messages from the IPCC report as well. One is that the warming trend is expected to continue through the middle of this century, regardless of which scenario they looked at in terms of our future emissions. They also found that in order to limit future warming, we need to deeply reduce our carbon dioxide emissions and other emissions of greenhouse gases. But unless those reductions take place in the next few decades, the warming that we'll experience in terms of a global average will exceed 1.5 degrees Celsius and 2 degrees Celsius this century. Those were two targets set by the Paris Agreement back in 2015. So we're already seeing changes unfold at an unprecedented pace. We're seeing sea level rise happening at nearly 3 times the rate it did in the pre-1970 period. And what does this mean in terms of risk to homes and communities? In 2018, my research group at the Union of Concerned Scientists put out a report analyzing the risks of sea level rise to coastal real estate in the US. We found that just in the next 30 years or so, more than 300,000 homes along our coasts are at risk of what we call chronic inundation, which is flooding that would happen on average every other week. Those homes have a collective market value of nearly $120 billion today. With the highest sea level rise scenario that we analyzed this century, more than $1 trillion in residential real estate is at risk, with a lot of that risk residing in Florida and New Jersey, two of the highest, most exposed states to sea level rise. If we look at flooding due not to sea level rise, but just to rain, there's a trend toward increasingly heavy precipitation events in our climate system. The flooding that we're seeing in Tennessee unfolding over the last few days is consistent, unfortunately, with observed trends and projected trends. We expect to see more extreme precipitation in the future. And if we look at wildfire, I'm out in California, so think a lot about wildfire. There are estimates that about 4.5 million homes are at high or extreme risk of wildfire in the US. And not quite half of those are in California, so about 2 million in California alone. We've also seen in terms of wildfire and how that landscape is changing, there are a lot of factors that are coming into play. There's the climate trends, where we're seeing warming causing more drying of vegetation, and that vegetation then becomes fuel that's ready to burn. We know that our forest management practices and fire suppression practices have exacerbated a trend toward larger and more destructive wildfires. But we've also seen a lot of people moving into wildfire-prone areas in the state. So nationally, the number of homes in the wildland-urban interface, which is a high-risk region, grew 41% between 1990 and 2010, which puts a lot more homes at risk when there is a wildfire and increases the risk of wildfires sparked by human causes. So just to kind of summarize all of that in a nutshell, all of the indicators point to increasingly severe risks to housing posed by climate change. That's true when it comes to sea level rise risks, flooding risks from extreme precipitation, wildfire risks. Limiting future warming would help to limit the magnitude of those risks, particularly in this century, though projections show that even beyond this century, things like sea level rise will continue to occur even in the face of dramatic reductions in our emissions. So a lot to think about there and a lot of risks to consider.
Yeah, Kristy, thank you so much. I mean, I think that really sets the stage for the next part of our conversation, which is to hear from Michael LaCour Little if we're thinking about synthesizing all of those different risks and both sort of the short term and then this longer term trend, and Kristy mentioned sort of a magic 30-year number there, which accords with a 30-year mortgage that we're all familiar with. I'm curious, how do these increasing climate risks inform the work that you do at Fannie Mae, and what kinds of questions are you and your team exploring at the moment?
Yeah, thank you very much, Ben. And thanks to the organizers at the Wharton Risk Center for putting this program together. I thought I'd talk about a few things just for the benefit of the audience, a very brief overview of Fannie Mae's business, and then talk about our efforts, which really go back to 2017 when we started this work, particularly focused on flood at that time, but culminating in 2020 when we created a climate impact group at Fannie Mae to think about climate risk more broadly. I also want to say a couple things about the two published papers that we put out there to try and help inform the market about some of these risks. And finally, if I have a chance, I'll just toss out some ideas that have come up in the course of our work about how we might take actions to make the housing and mortgage market more resilient. So first off, Fannie Mae's business, you can think of us as a very large insurance company. What is it we're insuring? We're insuring the credit risk on residential mortgage-backed securities that we issue backed by pools of loans that we purchase. And as pointed out, most of those loans are 30-year term, even if they don't necessarily last 30 years. So we, of necessity, need to take a long view. Now, the level of interest rates and the level of house prices and movements in those two macroeconomic variables are really the key risks to Fannie Mae. So to the extent climate change disrupts the path of home prices or causes sudden devaluation in the value of the collateral, that's certainly something that's very important to us. 2017 turned out to be a big year for flood risk. If you guys remember, there were a number of hurricanes that year that ultimately we ended up taking losses of about $300 million on. So getting started back in 2017, 2018 was probably good timing. And one of the first things we did was we reached out to the Wharton Risk Center and partnered with them on a number of projects, including the first paper, which I'll mention, Flood Risk in the US Housing Market. And then probably more importantly, the second paper, which I think Ben is going to drop the link to in the chat. And that's about the connection between the flooding events that occurred during and after Hurricane Harvey and loan performance on the Fannie Mae book of business in that particular geography. And one of the key takeaways from that study was that really almost all of our credit risk is outside of the special flood hazard area where borrowers are required by regulation to have flood insurance. And the key thing that we had for that study is that we had inspection reports on about 30,000 properties in the Houston area that were affected by Hurricane Harvey. So we could take a look at loan performance both in and outside of the special flood hazard area. And in general, what we found is that, again, our credit risk was concentrated in areas outside of the special flood hazard area. But we did observe a lot of prepayments of mortgages inside the special flood hazard area. as borrowers receive their insurance payouts. So we also were able in that particular paper to look at damage predictions. We had worked with one of the key cat risk firms to quantify the flood risk for each one of our properties in that area at the individual property level. And one of our key takeaways there was that damage prediction could be done relatively well at the aggregate portfolio level, but individual property damage prediction is much less accurate. So that's enough of my commercial about our existing published work. We do have a third paper underway. It deals with the behavioral biases that prevent homeowners from acquiring insurance and taking steps to fortify their properties in order to mitigate any sort of flood risk damage. So we've been doing a lot in this area for the last few years, and we think it's a very important area going forward, as evidenced by our creating that climate impact group within Fannie Mae. A couple of ideas, and these are not ideas that Fannie Mae would implement on its own, but just a few ideas. One thing that could happen would be the mandatory purchase area for flood insurance could grow larger. There is a 500-year flood zone as well as the 100-year flood zone. And that would certainly cover a lot more households. Ideally, I think, and we've talked about this with the insurance experts at Wharton, it would be ideal if a flood risk endorsement could be part of a standard homeowner's insurance and not something that the homeowner has to make an extra effort in order to acquire. Another idea that's out there is the idea of some sort of pilot program that has a mandatory offer provision to it at the state level. I'm told by our friends at Wharton that the mandatory offer program in California actually significantly increased the take-up rate on earthquake insurance. So perhaps something like that might work to help close what FEMA likes to call the flood insurance gap. And finally, I'm heartened that in the real estate market more broadly, certain vendors like Redfin are now including a flood risk score in their descriptions of properties on the market for sale. Certainly, if home buyers had better information earlier on in the process, they might make more informed decisions as to the risk of properties they were purchasing. Now, none of this, of course, means that flood is the only risk related to climate change that we face. And we do, in fact, have a disaster response network at Fannie Mae that deals with issues of wildfires and recovery and that sort of thing in addition. But I think I've probably used up my time, so I'd better stop here.
Michael, that was great. Thank you so much. I posted links to actually both papers in the chat for those who are interested. Let's turn to Matt next. So Matt, I think the last point that Michael was raising about information provision was a good jumping off point, perhaps, in thinking about providing home buyers with the flood score information on Redfin, the way that they would traditionally get the walkability of a property or the good schools rating. What are your thoughts on some of the kinds of broader market forces and innovation around these issues as they relate to kind of adaptation and resilience in the face of climate risk?
And thanks. My remarks are going to nicely dovetail with Michael. So he's Batman and I'm Robin here. So In my new book, Adapting to Climate Change, I go on for perhaps too many pages that because we are recognizing that Mother Nature is throwing ever harder punches at us, that capitalism is going to begin to step up to help us when enough people anticipate that they face a challenge. This creates a market for solutions. And so, Ben, my starting point in the real estate economics of climate change adaptation is that we face a known unknown. Ever more of us, I believe from both political parties, are aware that we face this known unknown. While there are challenges of reducing our greenhouse gas emissions, it's in the self-interest of individuals to protect their real estate. And that's one of the things I want to talk about. How do we create resilient real estate for existing homes, the millions of existing homes we already have, and for the homes we're going to build going forward? And I believe, Ben, that the insurance industry is going to play an absolutely key role here. And so what I see going on in academic applied economics is more scholars, including you and me, using all of this great spatial big data we have right now. So firms like Zillow and Redfin tell us the pricing of existing real estate. And of course, location, location, location. As you said, low crime, access to good schools, access to jobs, access to beautiful weather. But going forward, are you in a PM 2.5 zone? Like what Berkeley has now been exposed to? Are you in an area facing sea level rise, as Michael was just talking about? Consumers are more likely to bid more efficiently and not regret their bids if they have more information about known unknowns. Then, as you know, an issue arises. Who is a trusted source of information? There's new companies like Jupiter and First Street Foundation making engaging in spatial climate risk predictions. How do we know their models are good? Who will trust these models? And so a very interesting issue is, in the past, we've relied on historical data. How many times over the last 20 years has a parcel faced a risk? Going forward, for those who believe the climate science models at a given location, they'll be less likely to bid aggressively for such a property. Then here, the insurance industry can play a key role, playing the Paul Revere. In my libertarian fantasy, if government were to step back from some insurance markets and allow competitive insurance risk pricing to occur, home bidders, before they bid for an asset, would get an insurance price quote and to get a sense of what insurance will cost in the short run. And if you could sign a longer term insurance contract to get a sense of what insurance would cost for the same property 5 years from now, 10 years from now. And if you're quoted a very high insurance rate, you can shop around for a lower rate. But if several insurance firms try to charge you such a high rate, that you would bid less aggressively for that property because of your anticipation of the operating costs of owning that property. And so, Ben, a further thing that the insurance industry can do to further climate change adaptation is to offer a menu of discounts. If a property owner takes these steps, then you can get a discount for that property. And so I'm very excited about the possibility of the insurance industry helping to lead proactive investment so that Mother Nature's punches cause less damage to our real estate. Right now, there's more and more research coming out from academic economists documenting that properties perceived to be at risk are selling for a discount. In Ben's work with Phil Mulder, that these homes are less likely to be transacted in Florida in recent years. There's more and more research documenting that climate science is influencing real estate markets, and those properties that prove to be more climate resilient will sell for a price premium. And so it's in the self-interest of property owners to signal through Redfin and when they sell their properties that this is a resilient property. In my own work, I'm studying how the Army Corps of Engineers investments in flood control offer another way to protect properties. So, Ben, do we protect properties by putting your house on stilts, or the Army Corps of Engineers doing a public project? And of course, the answers depend on a case-by-case basis. I want to end my remarks pivoting to new homes. John Lennon and Yoko Ono had that song, Imagine. Ben, can we all sing that? Is this a very Imagine there's.
I was told there would be no singing on today's webinar.
Oh, Ben, that's I moved to USC. It's in my contract that I can sing, like Axl Rose. I can imagine the following rules of the game going forward. That because of climate science, because of companies like Jupiter, we identify where is higher ground outside of fire zones. Urban planners change our zoning codes that we upzone and build multifamily housing in those places. Urban planners work to have wetlands protected nearby to provide flood control. Mortgage lenders integrate with insurers to offer home buyers a package of a loan and an insurance rate that reflects the climate risk. And then the securitizers choose those loans and pay a market price that is risk adjusted. So, Ben, I can imagine a new set of rules of the game that integrate zoning, urban planning, housing construction, the mortgage industry, the insurance industry, and the securitizers into an integrated front that would help to protect us from Mother Nature's punches. And so going forward, we'd have a much more resilient housing stock going forward. And then there's a question with the used old housing. I'm a piece of 1966 capital. How do we retrofit that capital? But under these new rules of the game, where the insurance industry plays a key role if government gets out of the way, we would have a way to have a much more robust capitalism in the face of climate change. And that's one of the big themes of my new book, Adapting to Climate Change, that isn't selling like Freakonomics, perhaps because it's so logical. Thanks, Ben.
Well, thanks so much, Matt. I mean, I think your description there wove together both some market forces and some public entities as well. And when we're thinking about this kind of tangled web of the housing market and thinking about physical space markets. We think about things like individuals choosing where to live, but we also think about the federal role in the flood insurance program and the federal role for mortgages. And so that sort of, is a way to transition to thinking about Lynn's position at FHFA and thinking about the way in which the FHFA is thinking about preparing itself for sort of increasing climate risks and the entities that it's regulating. Lynn, do you want to kind of take it from there?
Sure. Thanks, Ben. And thanks to you and the Wharton Risk Center for the invitation today. As someone who is maybe a little bit newer than the rest of the panelists to this discussion, I can say I can appreciate all of your research to date and bringing me up to speed. Obviously some of Michael's work with Carolyn and others on flood risk, are some really seminal pieces. And then, Kristy and Matt, all of the work that you're doing. Thanks for your involvement, at FHFA as well. So what's going on, at FHFA? Well, I think, Michael pointed to the kind of pivot. One of the things that FHFA in conjunction with Fannie and Freddie have done is to develop a really robust toolbox to respond to natural disasters and other events. But what's really started to take place in the last year or two is to start pivoting that to more of a risk management point of view and to think, from the front end a little bit more proactively about the rising risk of climate change. And so it's sort of that pivot that I think is starting to show up in a number of our activities. And I wanted to talk just a little bit about what those are and to touch again on some of the points I think that have really great points that have already been raised, especially about coordination, not only kind of along that whole food chain that Matt just talked about, but within federal government, right? Kind of a whole of government approach that probably needs to be adapted so that we're not just pushing risk around the system, rather dealing with it in a more systematic and holistic way. So what are we doing? Well, like I said, we've kind of done a little bit of a pivot to thinking about risk management. I think places, we're acknowledging that in economic summits that we've been running, in press releases. We've done recent listening sessions on natural disaster and climate risk. And even in the capital rule, Matt, you said, the known unknowns. I think even, in the preamble to our capital rule, we acknowledge, one piece of that puzzle is sort of risk-based pricing, but that's very backward looking, right? Based on history. And we have to acknowledge that looking forward, there's this known unknown, set of unknowns that we need to account for. And so maybe we need a little buffer here. Maybe we need a little, capital in other places. So it's showing up, you have to look for it. But, one of the other pieces that I don't know that we've talked a lot about to this point is the fact that even as we're thinking about this from a financial, regulatory, and supervisory point of view, as a government agency, FHFA has really got to recognize that these climate-related changes could have a disproportionate impact on communities of color and lower income households, et cetera. So as we're starting to use this research to kind of pivot to policy, we've got to very carefully examine, anything that we do for those types of impacts and be mindful and thoughtful about, continuing to promote equitable access to safe and decent housing. So lots of balls in the air and lots of things to take care of. So just in the last year, actually last fall, we created a natural disaster risk working group. It's cross agency, so it's got the policy people in there, the examiners in there, the research, our accounting folks, all trying to come together across the agency to bring to bear a very multidisciplinary approach to thinking about these problems. We've had all kinds of meeting with regulators, and that group's published a request for input to the public. Thank you all for all of your input on that. We've had a listening session. Actually, let me see if I can talk. And Matt or Ben, I didn't send this to you ahead of time, but I'll send out the FHFA has a YouTube site where you can see, if you care to, you can go and see the recording of the listening session where a lot of different folks provided information to us. So a lot of good, hopefully a lot of good public resources will come out of this effort too, where we're sharing information that people are sharing with us along the way. So we're gathering a lot of information, kind of thinking about a learning agenda really at this point, building out our research capabilities. These guys are all in there, but we're bringing more data in-house. We've hired several folks who have energy and environmental PhDs in economics. I'm really excited to add them to our team to help us think about how we take research and then apply it in this context. I think the other quick piece I'd like to point out is, one of the things we've been working on recently is to both analyze and support what I'm going to call the climate risk executive order, right? President Biden signed a climate risk executive order back in May. It's sort of setting out this notion that the US government's going to get involved in incorporating climate risk and other environmental, social, and governance, right? The ESG stuff into financial regulation. And an amazing amount of coordination probably needs to happen in order to do that. Treasury Secretary Yellen, I think, said a couple of really interesting things recently and related to that, the importance of information. And so disclosures and other information need to be provided to the public. And obviously the federal government's in a good position to help with that. And also just this notion that we're going to need new tools, right? Somehow we've got to get market information into the financial analysis to think about financial risk. And possibly, we'll need to develop new methodologies to do that. So I think there's a lot of great work going on. Maybe the last thing I would say is we've also recognized that it's not just natural disaster and climate risk that we need to be thinking about. We've established a separate working group on just the ESG portion, because that's a whole nother set of issues that need to be considered within the agency. So I'll leave it there and be happy to and go deeper on anything that ties out to what else we're going to talk about.
That's great, Lynn. Thank you so much. Thanks everyone for your kind of opening introductory remarks. I think it gave everyone a sense of where you're each coming from and what you've been thinking about. I want to open the floor for questions. We already have a couple of questions that have popped up in the chat and the Q&A, but it would be great if you are thinking about asking a question to please do so now, and I will try to organize them and present them to whoever wants to field them. I guess I wanted to sort of start with one of the questions that came up, I was going to ask something very similar, but Roberto asked it in the chat. And I guess I'll start with Michael on this and thinking about risk assessment and the data that you're using to assess risk. It seems like we have a lot of different sources for flood hazard risk and flood forecasts. And so one of the challenges of providing people with information is that there may be discrepancies in the different forecasts. And maybe we can circle back to Kristy on that as well and thinking about the accuracy here. But the question was whether you're using things like the NOAA flood risk or whether you're using alternative flood hazard information from sources like Flood Factor or some of the other nonprofits that are working in this space. When you're trying to compile a risk assessment, what are the different data sets that you're using or interested in using at this point?
Yeah, good question. We did partner with two of the leading cat risk firms back in 2018 to get those property level measures of flood risk. I don't want this to be an advertisement, so I won't mention those particular names, but as you probably all know, there are a number of different firms that use different sorts of methodologies. And I will say that at the property level, the predictions were quite different. So that's one of the challenges. Again, the two firms produced aggregate estimates of risk and aggregate estimates of damage that were quite similar. But at the individual property level, there was some pretty wide divergence. Now, this work all started before First Street Foundation had come out with its work. I believe that our new climate impact team has been working with them, working with for example, Jupiter Intelligence, which provides a aggregate risk metric across multiple perils. So that's another example of third-party data sources that we've looked to use in assessing risk.
And thanks, Michael. And Kristy, when you're thinking about the sort of disparate forecasts that are out there that seem to be going all in one direction, but with some maybe large error bands, how do you think about the different sources of data, and also how do you think about communicating some of that uncertainty to a layperson audience that doesn't have your level of expertise, myself included?
Yeah, this is a huge challenge. I mean, it's very difficult to make decisions under uncertain conditions. And when we look at something like sea level rise, there's uncertainty from a number of sources, from our future emissions to the Earth system response to those emissions. We still see, despite 40 years of sea level rise projections being made, there's still quite a range of possible futures. So, one thing that I tend to look at if I'm evaluating a data set that's, purporting to report property level flood risk is what sort of timeframes are they analyzing? So if something is saying, giving you extremely fine-grained projections for every 5 years, it's unlikely that the data resolution for a lot of the data that's generating those predictions is going to be able to discern, the year 2025 from 2030. There's just enough uncertainty in a lot of that underlying data that those kinds of projections can be really difficult. And I would say that there needs to be better coordination across the board. So Flood Factor has these amazing property level projections. We know that FEMA has moved to this risk rating 2.0 system where they're also assessing individual property level risk. How do these things correlate with one another? Do they correlate? What can we be providing more consistent and more certain projections for property level risk than we're already doing, given that efforts are happening in very disparate places and with disparate methodologies?
Yeah, that's great. I mean, Matt, I was going to come to you next, but do you want to chime in on that point?
Yes. So what I talk about in my book is I actually want more of us to be renters. If rental housing was a closer substitute for owner-occupied housing, one strategy, Ben, is for more of us to rent from a professional management company. At many points in my life, I've been a renter, including when I lived in Baltimore. And so I'm a believer in human capital, and the managers of an asset, when you face a known unknown like climate change, should have the skill, the experience, the data, and the access to capital to manage this. And I'm a homeowner, but I'm an amateur homeowner, and we're going to need some human capital and some skill to adapt to what Mother Nature is throwing at us. And so, Ben, this may not be a popular idea on the panel, but I actually think the rise of renting is one strategy to better adapt, to put the decision-making in the hands of some experts and to encourage the development of expertise. In the future at Wharton, I could imagine you teaching courses on apartment management in the face of climate change. And that this human capital and developing human capital is key to adapting here.
It's an interesting point. So Allison in the Q&A asked about this idea, whether more information to prospective home buyers is always going to lead to better, sort of more risk-averse outcomes, right? And so one of the barriers is that people are not necessarily fully rational, that they don't incorporate all the information at their disposal. And your argument would be that if we professionalize ownership, that group is going to have a greater incentive to digest the research, to make more forward-looking decisions. They're going to have more at stake. They're going to have more experience. And they'll make better choices. So I think that's one interesting answer. I think the other kind of friction there, another potential barrier, is that the markets don't yet exist to do some of the things that you were describing, right? So you were describing buying things as a bundle, buying long-term insurance, flood insurance policies. We sort of recognize that a challenge with the flood insurance market is you're getting an annual update on your risk, but not necessarily tracing out that future trajectory that you'd like to know more about when making a long-term commitment, like developing a property or buying a home. And so thinking about some of these frictions that are in place to your, I think you described it as a libertarian fantasy, right? I think one angle of that is the angle that Allison raised is that people aren't necessarily rational. And so your answer to that is sort of to professionalize it. I'm curious in terms of being a market maker, so creating this market for solutions. So how are you thinking about this type of innovation occurring, and would it happen more from these large public market sort of players? So the Fannies and Freddies and FHFAs of the world, the NFIPs of the world, or do you think that the innovation is going to happen more in the private side?
I love your question. If Donald Bren built a new seaside community, so he built that community in Orange County, if a real estate developer, if he or she could acquire a large enough parcel, would internalize all of the costs and benefits of setting land aside as wetlands, of the urban planning. So, Ben, I think a key issue here is land assembly. And if there were large parcels that could be developed, almost going back to Paul Romer's charter cities, of the potential that the private sector could handle this. But I'm very sympathetic to the point that with our fragmented land use, that there's a whole bunch of coordinated decisions that amateur homeowners like me will have to coordinate. And so I don't know the answer to your question.
So on that happy note, so Lynn, I want to go back to a point you raised, which I thought was a great one, thinking about equity and just thinking about the challenge of low-income households and low-income communities in the face of rising climate risk. So on the one hand, you have rising insurance rates in those areas, at least anticipated over the next 10 years. Risk rating 2.0, sort of the elephant in the room. We don't yet know exactly the details on what effects that's going to have distributionally in terms of high income communities, lower income communities. But we're thinking about insurance rates rising, and then we think about the vulnerability of infrastructure, which is a point that Doug just raised in the Q&A, that bearing those costs locally is going to be challenging for a low income community that may have its tax base eroding in the face of rising insurance costs, meaning lower property prices. So how should we think about sort of government policies or programs to continue to keep access available, to keep sort of access to insurance products available, while at the same time kind of addressing some of these efficiency and risk-based pricing problems?
Wow, that's quite the loaded question, but it's a really great one. It's a complex one, right? I think one of the interesting takeaways we've gotten from the RFI at this point is this notion that government shouldn't move too fast because they need to bring everybody along with them, but we also can't wait too long, because then you're going to allow these situations to continue to develop, right? For people to continue to perhaps make decisions without full information, to put their wealth at risk in different places. And so this notion of timing is something that's come out of the RFI that I think is pretty interesting. I don't know that federal government, and certainly just a mortgage regulator, can do it all by themselves to this point of coordination and needing all these. Land use planning's got to be a part of this. It's got to get smarter. We've got to, think about our housing supply problem alongside of our natural disaster and climate risk issues. To Matt's point, finding the places that should be developed more intensely and starting to slowly provide more opportunity in places that aren't at as high a risk is got to be a kind of an important part of all of this. I don't have the answers as to how we are going to be able to address rising insurance costs. I mean, watching California right now, I'm worried about places being able to get insurance at all. If that market isn't allowed to adapt quickly. It's something that as we approach each policy, we need to kind of understand the facts on the ground and then recognize the potential impacts and then try to design policy, around it. But it's not going to be a one size fit all type approach, almost for sure.
No, that's great. And sorry, I didn't mean to leave you with such a loaded question, but it's a thought that's been on my mind a lot in thinking about these trade-offs. And there's definitely no simple, silver bullet solution. I wanted Michael to come back to you with this new project you mentioned about take up of insurance and thinking about flood insurance. And so there was a report from last spring. I'll see if I can find the link where the FHA was looking at the effectiveness of the mandate, right? So the mandate to take up flood insurance. And I think the statistics, if I'm remembering correctly, were about a third of Florida homes that are FHA-backed loans that are in the flood areas do not have flood insurance, and about 50% of North Carolina homes that are in the SFHA, backed by FHA, do not have flood insurance. So it seems like there's a pretty big gap in terms of enforcement on the mandate. But I'm curious in thinking about the role of sort of that beliefs play. And this is partly off of a question from Nitsan in the Q&A. Is your group measuring household beliefs regarding climate change and thinking about sort of beliefs around expected losses or expected disasters in thinking about take-up rates? Is that part of what's going on there? I think Martha just found the study that I was referring to in the chat. So thank you, Martha. But is that part of the project that you're working on, is eliciting beliefs, or is it more ex post?
Yeah, no, we did do some survey work, had about 3,000 households respond to a survey where we asked them questions about their beliefs about flood risk, both there on their own property and in their neighborhood. And we asked them questions about whether they knew anyone who had experienced flood damage and whether they thought their property was at risk this year, in the next 5 years, in the next 10 years. So we elicited a number of responses like that. And what we were trying to do in the paper is to test some of the theories that Howard Kunruther at the Wharton Risk Center developed about bias, natural behavioral biases, myopia, optimism. There's a whole set of them. I can't rattle off all of them off the top of my head. But generally speaking, we found that to the extent households were, overly optimistic, for example, they were less likely to purchase insurance or think about fortifying their individual property. So yes, we did do some work on that, and that paper's in draft now, and we can make it available soon.
That's great. Well, we look forward to seeing it. Hopefully soon. So Matt, I wanted to ask you about incentives and about sort of adaptation incentives and otherwise. And partly this just comes down to who bears the final costs of these disasters and of these risks. And so if we think that right now the risks are borne in part by the NFIP or other entities like that, if we're thinking about incentivizing developers in particular, and I'm just rephrasing a question that Laura had in the Q&A, if we're thinking about developers of new communities, and we want them to build in a more resilient way, but they don't sort of bear the final risk, what are the right ways to incentivize development towards sort of more climate conscious development?
I think that's a great question. So Ben, there's a question whether they should have skin in the game, whether they should own 20% of the units and not be able to sell all of them. So a smart business professor could think of those incentives. There is, again, there's a question of our imagination. When a home buyer buys a home, how is she thinking about the dividend stream, the rental stream for the next 40 years? And Ben, one of the themes we've been discussing throughout the hour is this behavioral economics. I'm an old University of Chicago economist, and the more the efficient markets hypothesis lurks here, the more optimistic I am, because several times today, and we've had this puzzle that if home buyers don't know that they don't know what risks they face, if they lack self-awareness of their own biases, they're going to regret the bids they've made. So Ben, in my writing, I've talked about who's the adult in the room. And so I want to come back to these management companies. If Jeff Bezos, and I know no one wants to hear this, but if Jeff Bezos owned every property in America and rented it out to each of us Homer Simpsons, we'd be much better able to adapt to climate change, because he and his team at Amazon would build up a resilient real estate stock. The cliche of Mr. Spock from Star Trek, there's a question of if we know that we don't know what climate change is going to pose, we're going to bid much less aggressively for properties at risk. If we are naive about risks we could face, we could blissfully overbid. And so, Ben, I think we need to think about, how do we help amateur homeowners to be more sophisticated, or how do we help them to sell to more sophisticated agents? And then capitalism will help us to adapt through a smooth process of investment under uncertainty.
I mean, I think there's a lot to unpack there. I mean, certainly in my work, we find that it does look like areas that are more worried about climate risk and areas that lean more democratic in terms of their voting are more likely to ask for discounts on their properties. And so you see a price decline in those places. And Asaf Bernstein and co-authors find something similar, that it seems like there's some voting. They describe it as voting with your sandals, right? So Republicans moving to some of these areas less concerned about these coastal risks. I mean, I think one of the challenges there is again sort of back to this equity concern, right? That there's a group of people who have this sort of flexibility to adapt gradually over time and can sort of have the liquidity to do so. There's a group of people who have much less choice, who are much more constrained on their budgets, may be very constrained in certain markets in terms of the neighborhoods that they can afford to live in. And then sort of the ideal version of this is a smooth transition, right? So from one equilibrium to another. And the challenge, I think, is that you have, with the rising temperatures, you also have rising tail risks. And so you have the chance of sort of catastrophic risks. And I wanted to come back to Kristy to ask about catastrophic risks and how that fits into some of the work that you've done. So you've done the work on sort of sea level rise, which we think of as being this kind of gradual progression that's going to lead to additional nuisance flooding and chronic inundation, but you kind of have to overlay on that the kind of tail risks of severe storms, of hurricanes, of extreme drought and extreme fire events and things like that. And so how do you think about that tension between the sort of gradual risks and the increased likelihood of extreme risks?
Yeah, so in our work, we've tended to focus on the gradual risks, the sort of risks that will creep up on us over time until eventually a homeowner or community finds that they're in a completely untenable situation. But obviously that's only one component of the risks that a coastal environment or a wildfire-prone environment faces. And I think the real key in thinking about these two types of things is that some of our response to them needs to be the same. And this goes back to something that Lynn was saying about needing to move from this disaster response mindset to a disaster preparedness mindset, and really getting out ahead of disasters before they happen, whether those disasters are punctuated events like a hurricane or a wildfire, or whether they are slow-moving, unrolling disasters over the course of decades. So I think that's sort of how I think about those two frames, not being so dissimilar when we think about it in terms of decade scale risks that a homeowner might face.
So we just have a couple of minutes left. I wanted to ask Lynn one more question, sort of following up on something you said earlier about coordination and sort of what do you see as kind of the next steps in coordination, right? Because we can think of sort of state, local, federal coordination. We can think across markets in terms of insurance markets and mortgage markets and reinsurance markets. How are you thinking about sort of those different pieces, and what do you think the next steps would be to make progress in that direction?
I think maybe one way to think about this, at least from our point of view right now, is the first step is just participating in some of, like this FSOC working group and other things to make sure that we're sharing information and starting to generate information, right? By thinking about how we can actually quantify and describe the risks that are present. Hopefully we can then start bringing more people to the table, maybe along the lines of what Matt's talking about, right? If we can paint the picture a little bit more clearly, start thinking about ways, what tools we need to continue to work with other researchers to bring that information to bear and think about what the possible future risks look like. We then start having the ability to bring more people to the table. So I think you have to take some small steps here, sharing information within the federal government, coming up with a kind of a whole of government approach to how you're then going to make the reach to other parts of these communities, like you said, state, local government. Maybe there's a greater role for state governments to play in providing some coordination mechanism that hasn't worked in the past with local land use regulation, trying to provide some coordination there, but that might be one step in the puzzle that needs to be re-examined. But I think, information is going to be the first step, continued research, and then, trying to start coming up with some policy proposals. I don't know that much, and I think, Michael, you've done a little bit more research about this, about private insurance industry, right? We're very dependent upon, certain, the FEMA insurance product in the flood world right now. And, I think both Matt and Kristy have talked about other types of insurance products that might be brought to bear and might help that individual homeowner start pricing in some of the risks that they face. So I think we need more understanding of how the private insurance market might play a greater role here.
Yeah, that's I think a great place to wrap up. We are at the top of the hour, and so I've been mandated that we need to wrap up in a timely fashion. I think we could continue this conversation for many hours. We've just scratched the surface. So hopefully, you know, in a couple of years, we'll all come back and do this again, and we can have an updated round of where we are on both the sort of the science and what we've learned about the state of these risks, and then the ways in which we're managing them, and the ways in which they're being felt in the mortgage and housing markets. So I want to thank everyone for joining today. I especially want to thank our panelists, Kristy, Michael, Matt, and Lynn. This will be archived on YouTube somewhere for posterity. Thanks to everyone who submitted a question in the chat or in the Q&A, and thanks especially to the Wharton Risk Center for organizing. So I will leave it there. Thanks everyone, and have a great afternoon. Take care.